You know that feeling when you look back at something and think, wow, I wasted so much time? Well, out of the 547 days I spent learning about investing, I would say half of that was wasted chasing pointless strategies that never actually worked or came to fruition. And maybe you're in the same place I was a few years ago, working part-time jobs thinking that you need thousands of pounds to start investing, but the truth is you don't. You just need time, patience, and a few fundamental lessons. Now, famous Greek philosopher Epictetus once said, if you want to be beautiful, make beautiful choices. And in investing, every choice compounds. And if you get the choices right, those outcomes can be beautiful too. Now, whether you're a beginner or you're a seasoned veteran of investing, I'm sure you'll find some nuggets that you wouldn't have learned otherwise. So, let me show you the points that I've learned to get me in this position today and to be able to stay consistent with my routines and overall investing, so you don't waste the time that I did back then. Now, when I first started investing, I thought I could outsmart the market, and I feel like we all kind of go through that period when we begin, especially doing something new. And I'd literally sit there staring at charts, staring at the price action, drawing lines, etc., thinking I had a holy grail to predict the tops and the bottoms. And the truth is that not even the best investors in the world can do this, right? Especially not consistently. So I flipped my approach. I now focus on the fundamentals. I focus on what innovation and growth are driving the companies, and valuation is a key indicator for me before even getting into a position. Now, playing the game of picking tops and bottoms can very quickly set yourself up for failure, and it will literally lead you down a dark path, and you'll start spiraling and making bad decisions. And it's not your fault, because there is a lot of stuff online and it kind of shows you to think like that. But when you take a holistic outcome and an approach, you really want to understand what the company is doing, who's in control, and what is driving your earnings at the end of the day. Now, the real magic happens with time in the market, not trying to time the market, right? And that's why I use a strategy called dollar cost averaging. Essentially, instead of deploying a lump sum of capital into a stock or an ETF, you break that sum up into smaller chunks and you average into positions and scale in, right? So you could be buying every week, for example, you could be buying every month, and that's what I like to do. Because think about it, it takes away the stress, it takes away the chore of investing, and it allows your wealth to compound over time. It's not glamorous by any means, it's not a fancy strategy, but it works, and it's what some of the best investors have done for decades, right? And at the end of the day, if it's not broken, don't try to fix it. And that's why I stick to those rules of thumb. Now, another mistake that I made was thinking that markets were rational and logical, that prices went up or down because of careful reasoning and well thought out decisions by institutions and players on Wall Street. Now, although that they have their estimates, I quickly realized that this wasn't necessarily the case. A lot of market sentiment is driven by human emotion of how people are feeling about that certain scenario or stock at that period of time, depending on the story and the narrative that's being manufactured at that point. For example, there have been stocks that rally consistently that don't really beat earnings. Why is this? Maybe because people who are buying into the stock are really buying into the founder, really believing into the vision, and that this stock will essentially someday beat earnings and become profitable in the future. Sometimes it's about strategic positioning with certain stocks, and people always have their reasons for investing in certain assets and companies. So it's really important to understand the narrative of what's happening within the stock, as although a company may not be profitable, there could still be some growth within that stock. Now, if you really think of it, markets are essentially a massive WhatsApp group chat run off fear and greed. A single piece of news drops and everyone panics. I mean, if we just have a look at the power that Donald Trump has over tweeting certain news snippets and how people can be so irrational in their behavior. Or if one stock explodes, everybody all of a sudden wants to pile in. I mean, if we have a look at Palantir, again, a very fantastic company, definitely a growth company, especially with the investors backing them. But everyone can see that the stock is clearly overvalued, but still continues to rally. So Does that necessarily mean that buying something that's logical makes sense? Not necessarily. It all kind of depends on the scenario and the picture that's being painted and why people are piling into the position, because sometimes you have to realize that growth is a very key factor in terms of why stocks will rally. It doesn't necessarily mean that the company has to be making solid earnings or being at a fair valuation for it to then start to rally to the upside. And that's what I didn't really understand before, but I've got a very firm grip on it now. Now, I once reviewed a friend's portfolio. He had over 50 stocks within there, and he's asking me for some suggestions of how he should best manage his current stocks because he thought he was well diversified, but he was completely wrong. Now, as we can see from the chart below, we can see that more stocks added to the portfolio, the less volatility of that portfolio, right? As volatility is associated with risk, as we can see heavy swings to the upside or to the downside, right? Causing more uncertainty within that portfolio. But this way of thinking can clearly be misleading. As I reviewed my friend's portfolio, I realized he was heavily concentrated within the technology sector. So he was actually doing worse by putting all his eggs into the tech sector when he could have dispersed and put some capital into some other industries as well. Not to mention all the fees that he would be paying every time he would enter and exit a position. He thought he was reducing his risk overall, but instead he was blindly creating this risk. It's almost like going to a buffet and just loading loads of different foods on your plate, right? It doesn't mean that the meal will taste any better. Now, quickly learning about the law of diminishing returns will make you realize that diversification isn't about buying everything in plain sight. It's about carefully choosing stocks or ETFs that complement each other to build yourself a robust portfolio. Peter Lynch, a famous investor back in the 1990s, was managing Fidelity's Medallion Fund, and he got to a point where he had over $14 billion of assets under management. And even he suggests that an optimal portfolio can range between 3 and 10 stocks, considering if they balance each other out and complement each other, as we want to make sure that we're not over invested in any particular sectors or regions. This will also give you a lot more flexibility, especially when you're rebalancing and putting money back into stocks that you've already bought to allow your compounding effect to occur. Now, broadly speaking, this is the rule of thumb that I follow, as currently I only have 4 stocks within my portfolio and the rest of my portfolio is within different ETFs. Now, it's also easy to waste so much time on investing apps that don't promise what they say they're going to do or are generally just difficult to use. And trust me, nothing kills your confidence more than struggling to withdraw money from an investing app. Switching to a simple regulated app was a complete game changer, as I wasn't focused on the app or withdrawing or depositing my money. I could actually focus on my investments and make better decisions. And in the past, there's been instances out there with certain providers increasing their fees. If we have a look at Vanguard, a lot of people had their main portfolios on the Vanguard app, and all of a sudden they started increasing their prices and fees, and people would now have to transition their portfolio from one platform to the other, which can be a complete headache and not something that you want to focus on. So it's always good to find a platform that works for you and stick with them for the long term, as you want to build on one sort of platform to not confuse anything. It's like upgrading from a Nokia to an iPhone. The journey becomes easier and you can actually make sound decisions. Now, if you've been watching my channel for a while, you know that I use Trading212 as the main host for my portfolio, but that doesn't mean to say that I ignore the other apps out there. I've also been looking at different apps like Lightyear because they have specific features for analysis that can kind of help me with my investments. There's also different communities on different apps, so that's not to mean to completely ignore the other apps, but what I'd suggest is having your main portfolio, your main residence on one app to not confuse yourself, especially when you're making those longer term decisions. Now, the right app is pointless if you don't know where to look for ideas to start investing into stocks in the first place. Now, I quickly realized that why don't I go straight to the source, have a look at the company website, read their transcripts, have a look at different earnings reports and their financial statements to give me a solid understanding of how the company's performing. And then to supplement that, I'd use tools like Perplexity, tools like Alpha One, to really have a look at comparisons of different companies, and also use their AI features to ask them questions about the company so I can get a broader overview of what I'll be getting into. Social media can also be a good way to get a starting point, but it all depends on who you're following, as there is a lot of misleading advice out there. Now, you don't get to understand stocks by listening to rumors and speculation about them. You spend time looking at the charts, reading the fundamentals, to build a conviction and a narrative in terms of what you'd be looking at to buy. Doing that will make life so much easier, especially when there's periods of volatility and people are getting shaken out of positions. You would have built up your methodology and thesis, so you would have the confidence and conviction to hold the stocks that you're already in. So those are the 5 fundamental lessons that I wish I had learned sooner, that somebody would have sit me down and told me step by step of the common pitfalls to avoid, as I'm sure I would have been well ahead of where I am currently right now. But nevertheless, we're always learning and growing, and if you're new to the channel, feel free to drop me a like and subscribe, and let me know your thoughts below. Is there any other lessons that you may have learned or are finding challenging at the moment? As I'd be great to kind of go over that in another video. And if you haven't seen my last video, I do a lot of portfolio updates to show my journey. So let me know what you think, guys, in the comments below.